Hello, everybody, and welcome. This is Financial Statement Analysis, Part 5. My disclaimer and copyright notice: the information, opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So we're going to be talking today about the price to book ratio. And why am I on this one in particular? Well, when we look at some of the different ratios that we've been looking at that are in this category specifically, I'm going to go back over here to a prior slide, which is really like price to book, price to earnings. This metric is extremely valuable because what we're really doing is we're looking outside and comparing the stock price or the market cap of the company to what is on the financial statements. So give you an example. When we look at price to earnings, what I would typically do is I would take the stock price of the company and I would divide it by the earnings per share of the company. If I go to Facebook or to Meta Rewards, so Meta right now has a price to earnings ratio of 14.97. Let's kind of figure out how that number is computed. I'm not going to have you do that for this class, but what this means is it's going to take the company 15 years to earn back its share price. So let's go through and take a look about how that is computed. So, and this is just going to be for fun because I'm not going to have you do this ratio. So price to earnings ratio. So for Meta Platforms, the stock price of Meta is currently, we'll say we can just go ahead and use 206.16. And let's go over here. So 206.16, that's the price per share. Now let's go through and take a look at this. So for Meta, if I go through over here and I want to know what is the earnings per share for Meta? If I come to the income statement for Meta Platforms, and where I want to go is right down over here. So the earnings per share is roughly about, we'll just call it $13.99. So if I take the price per share, so this is my price per share, my earnings per share, and we said that we'll just go ahead and use $13.99. When I go through and I use these amounts, we'll see if we can get close to what's showing on, we'll see if we get close to the $14.97. I think we should. But if I look at the earnings per share for Meta, it is right now $13.99. We'll see if this works. Always fun to see. And we get 14.74 or 14.73. So if this is pretty close to what the price to earnings ratio is showing up over here, but that's how that's calculated. What this means is it will take 15 years for Facebook, or 15 years of earnings for Facebook to earn back its stock price. Now, does that indicate if the company is over or undervalued? Who knows? If I went through over here and if I did Twitter stock price, what you're going to notice is the price to earnings ratio is not applicable. Why is it not applicable? If you're at a loss, it's going to show up as a zero because there are no positive earnings. Now, the interesting one is going to be Tesla. Tesla, when you look at their price to earnings ratio, this is 174.87. What does that mean? It means it's going to take Tesla 174 years to earn back its stock price. Now, to be fair to Tesla, is that when you look at Tesla's numbers, there's a lot of different things that are not necessarily going to be included in Tesla's financial statements, as well as a lot of these other companies. But again, this is oftentimes, as we would say with the price to earnings ratio, is how overvalued or how undervalued a company is. So just think about this right now. So if I look at Ford, and so Ford, their price to earnings ratio is 4. What does that mean? It's going to take 4 years to earn back Ford's stock price. And some people might say that, well, Ford, because of their dealer network, it makes them a lot more inflexible compared to a company like Tesla. It just really depends. But in any event, as we look at companies like Ford, or if we look at like GM, this can kind of give us an idea, and this price to earnings ratio is 7.25, meaning it's going to take GM 7 years to earn back their share price. Just gives you an idea in terms of how overvalued or undervalued you are. For Alphabet, their price to earnings is 23.26, 23 years to earn back their stock price. If we look at Microsoft, their price to earnings ratio is at about 30. So we could go through and take a look at these different companies. Let's take a look at Apple. And for Apple, the price to earnings is about 27.78. So Tesla is definitely on the high end, but Tesla is a very different type of stock. Okay, so I would call it more psychology than anything else. But I would obviously, though, at the same time, if Mr. Musk ever called me up and said, "Hey, Tchaikovsky, you're crazy," I'd say, "Well, I don't know what your company's worth," because I know that accounting is not going to necessarily capture everything. So, but part of the reason why I don't really like the price to earnings ratio is that, to me, it's not necessarily, in these times, it hasn't really been indicative of a company's value. So the ratio that I want to go through and use instead is going to be the price to book. And what is the price to book ratio? Well, right over here, as we can kind of go through and see, the price to book ratio is going to be, so it's going to be book value per share, and assets, it's divided by taking the company's stock price per share by its book value per share. Now, what I'm going to do instead is we're just going to take the market capitalization and we're going to divide it by the company's book value. So that way it makes it a little bit easier, but we're going to come up with the same thing. But the book value is equal to its carrying value in the balance sheet. And here we go. So the book value is also the tangible net asset value calculated as the total assets minus intangible assets and liabilities. So when I had you go through and do the accounting add-ons, there was a very important reason for doing it. And it was basically because when we go through and we're looking at the companies, when we're taking the market capitalization of Meta Platforms. And what I'm going to do over here is that my market capitalization for Meta, if I see here market cap, this is 561.16 billion. So let's go ahead and use that number. And let's actually convert that into billions of dollars. Okay. So this is in real dollars. So this is their market capitalization for Meta Platforms. And this is as of 2022. What I'm going to do is I'm going to divide this by the net book value as defined by the price to book value. So this is going to be assets minus intangible assets minus my liabilities. So over here, because we went through and did this for the add-ons, this is why this step was so important. When I come over here, my assets, we'll just go ahead and use this one right over here. We'll start at the number less the leases. My intangible assets were right over here. So my assets less my intangible assets are 132,283,000. My liabilities without my operating leases are going to be 27,235. So my net book value is going to be 105,048. But this is in millions. So to convert this up over here, what I'm going to do is I'm just going to make that quick conversion. So right over here. So what I've done is the net, what do we call this? We'll call this book value per Investopedia. So right over here, when we divide this over here, this is going to be giving me about 5.34. So if I looked at the net book value of Facebook, it's basically trading at about 5 times my net book value. Now, a thing about meta platforms, one thing that's really important to remember is that when you're investing into meta platforms, you are investing in Mark Zuckerberg. And why is that? It is because when we look at meta platforms, you have 2 different classes of common shares. And so does Facebook have a lot of value? And the answer is absolutely yes. But at the same time, though, too, if you're a shareholder of this company, you really don't have a lot of control. It's all really within Mr. Zuckerberg, who owns a special kind of stock that has a huge amount of voting rights. He can never be voted out. And that's what a lot of members of Congress are kind of coming to realize now, and that there's an issue with that. So over here, let's now go ahead and do this for Twitter. So when we come over here for Twitter, so this is going to be for meta platforms. And now we're going to go ahead and do this for Twitter. Okay. So the market capitalization, we're going to go ahead and use the same date. So for Twitter, my stock price for Twitter, and really what I'm interested in is the market capitalization. So this is $27 billion. So we'll go ahead and say right over here. So here you go. So this is the market capitalization for Twitter. Now, as of December, and where did I get this number from? I'm using real dollars. This is 27,480,000,000, 27,480,000,000. Okay, so this is my market capitalization. Right over here, my book value per Investopedia. So again, I'm going to use the same calculation that I went over here and did for meta platforms. So over here, my assets are going to be, let's go to our accounting add-ons for Twitter. Assets over here without the operating leases, 12 billion. My intangible assets are going to be the goodwill less the other intangibles. So my assets less those intangibles are 11,395,000,000. So over here, my liabilities for Twitter. So when I'm eliminating those lease liabilities, getting right over here at 5,458,000,000. So my net book value over here for Twitter is going to be 500, but this amount is in thousands. Okay, so right over here. So when we look at this, and what's interesting is like, okay, so right over here. So when we look at Twitter, their price to book ratio is about 4.62. So when you look at this, as Facebook is valued higher relative to Twitter, but when we look at both of these stocks have seemed to have taken, so Twitter has been, I may have been one of the IPO'd, but when we come back over here, we're now at 34, 32. So so Twitter is almost at the low point right now. Actually, no, it got bad in 2016, but they're certainly not off where they were in terms of their highs. So, and when we look at Facebook, and by the way, just so you know, Facebook is not at its all-time low. So Facebook right over here, when it started out, it was when it went through an IPO'd, it went down to about 20 in October, and then it's been on a gradual upswing ever since then. But again, when we're going through and looking at this in terms of computing the market to book or the price to book, you would say that, well, which one is a better, relative to these two companies? You would say that, well, from a price to book standpoint, Twitter might be a better bargain because it is not as highly priced. However, that does not necessarily tell the whole story. And that will be our next topic when we go through and we start going through and then finalizing this paper and getting into the very last part. So price to book ratio, again, I like to use this particular ratio because I'm taking the market capitalization. I'm not dividing it by earnings, but I'm looking at the book value. The reason why I like this book value is because we're removing intangibles, leases, as well as the goodwill and intangible assets. And then over here, I'm coming over here with my liabilities and getting down to my net book value per the Investopedia ratio. And again, as you're going through and you look at this for a lot of companies, if I went over here and I decided to look at Disney, and I know many of you like the House of Mouse, which is great, but I do want to show you something which is kind of an interesting thing about the Walt Disney Company. When you look at Disney's assets, as of January 1st, 2022, they had about $203 billion worth of assets. But if you look at the composition of these assets, 16 billion in intangible assets, 78 billion of goodwill. If I add up these two amounts together, this is roughly about 94 billion. So 94 billion, or almost half of their total assets, are really in, half of their assets are in intangibles. So on a net basis, I'm really looking over here at about 110 billion. And this is really kind of, when you add up all their liabilities, these get to be pretty significant. So in any event, we'll be concluding, and I'll be bringing you back in for the very last part of this, which is going to be the writing of the actual paper. I want to thank you for being here with me today. If there are any other videos that you would like to go through and see, please feel free to leave me a comment. Have a great day.